You check your banking app on a random Tuesday. Balance $0.14. And you don't own a single credit card. You've spent years actively avoiding one. That should be impossible. Credit cards are the thing that's supposed to wreck you quietly while you sleep. You did everything right, except you didn't avoid debt. You just stopped calling it debt, and it followed you home through half a dozen different apps. Somewhere on your phone right now, 4 or 5 small accounts are quietly tracking what you owe. $10 here, $40 there. None of them big enough to notice. Add it up, though, and someone paying $10 a week across several apps can be carrying thousands in obligations that no credit score, no bank statement, and no single app will ever show you in one place. Klarna, Afterpay, Affirm, built to feel like a discount. What they actually built is a second set of payments, running behind your real bank account, deducting your future income while you sleep. In class, at the gym, here's the mechanism plainly. Buy now, pay later splits a purchase into small payments and removes the one thing that used to make you hesitate before spending, the pain of paying. Behavioral economists have a name for that hesitation, the discomfort of handing over money. BNPL doesn't lower the price of anything. It lowers how much the price hurts. A $100 jacket becomes 4 $25 charges, and your brain, bad at multiplying small numbers back into large ones, files it under cheap, not debt. One industry report tracking BNPL checkouts found order sizes jump by roughly 40% when the option is available. Not because people got richer at the register, because their brain stopped registering the cost. So a whole generation that swore off credit cards because credit cards felt dangerous and visible, built something that isn't visible at all, and calls it responsible. And to be fair to the apps for a second, the instinct wasn't wrong. Credit cards charge north of 20% a year if you carry a balance, and plenty of people got burned learning that the hard way. Splitting a payment into 4 isn't inherently predatory either. Layaway did roughly the same thing 60 years ago, minus the smartphone. Pay all 4 installments on time, and you genuinely owe nothing extra. Picture the actual checkout. Someone stares at a $60 pair of shoes, hesitates, and almost closes the tab. Then a button appears, 4 payments of $15, 0 interest, and the hesitation just evaporates. They weren't lying to themselves. $15 really is all that leaves their account today. What they didn't calculate is that next Tuesday and the Tuesday after, another 15 leaves too, alongside whatever else they signed up for, the same way, the same week. But Layaway made you wait for the product until you'd paid for it. BNPL hands you the product immediately and asks you to trust your future self with the bill. That single reversal is where everything else in this video comes from. The industry calls this financial flexibility. Translated out of the press release, that means the moment where you'd normally stop and ask if you can afford this has been quietly removed. Every time you check out with one of these apps, it doesn't touch your real bank balance the way a debit card would. It opens something closer to a phantom account bolted onto the real one, an account you can't see filling up. You can check your real balance anytime you want. You cannot, in one place, check what all your phantom accounts add up to right now. Today, this second, follow $1 through the system, and the design gets clearer. You spend it at a store. The store never really gets that whole dollar. The payment company fronts it and takes a cut. And what shows up on your end is a promise to pay small pieces of it back on a schedule you didn't design. That's not an accident. It's the entire product. Retailers pay these companies a fee of 3 to 6% on every purchase, several times what a normal card processor charges. They pay it gladly because shoppers using buy now, pay later spend roughly 40% more per order than shoppers who don't, which means the merchant isn't really the customer here. You are the thing being optimized, and the 4-payment plan isn't a courtesy. It's a conversion tool wearing a customer service costume. And because Klarna doesn't know what Afterpay knows, and Afterpay doesn't know what Affirm knows, nothing stops you from opening 3 or 4 of these phantom accounts in the same week, off the same paycheck, without any of them finding out about each other. There's no shared ledger. There's no single institution watching the total. Each app only sees its own slice of your income, and each one assumes it's the only slice being taken. A $100 billion industry now runs almost entirely on transactions, too small to trigger anyone's alarm. A $12 installment on a pair of shoes, a $9 payment on a phone case. Zoom out far enough, and the biggest debt trap of a generation turns out to be built entirely from purchases nobody would call debt. Nobody wakes up frightened about the shoes. They wake up frightened 8 months later, when a handful of unrelated small payments all land in the same 48 hours, and every phantom account stops being invisible at once, which means the real damage was never any single purchase. It's what happens the day your income doesn't stretch far enough to cover all of them landing together. Miss a payment, and most of these apps don't report it. The way a missed credit card payment gets reported, which sounds like a mercy, It isn't, because it also means the debt never shows up on your credit report while it's accumulating, so neither you nor a lender nor a landlord checking your credit can see it building until it's already a problem. The fee for a missed payment is usually flat, $7, $10. On a $40 installment paid over 6 weeks, a flat fee like that works out to an annualized rate north of 300%, higher than almost any rate ever printed on a piece of plastic. They don't call it interest because legally, in most cases, it isn't. They call it a late fee. Stripped of the paperwork, it's a penalty rate that would be illegal to charge as interest, charged instead under a different name. And because these payments pull automatically from a linked debit card, missing one doesn't just cost the late fee from the app. If your checking account is short, your bank adds its own overdraft charge on top, sometimes $35 for a payment that started at $10. Run that forward across 4 apps instead of one. 4 small payments, timed to hit the same 48 hours, land against an account that only has enough for 2 of them. That's not 4 separate mistakes. It's one thin week, multiplied by a system that was never designed to notice how thin the week already was. One missed a $10 payment can trigger 2 separate companies charging you for it. The app's late fee and the bank's overdraft charge stacked on top of each other, neither one caused by a decision, just by several phantom accounts pulling from the same account on the same day. Regulators have started asking BNPL companies to report this data. Right now, in most cases, they still don't have to, which means the real number, how much of a generation's income is already spoken for, before it even lands in their account, mostly doesn't exist in any data set anyone can point to, which means nobody, not a bank, not a regulator, not the apps themselves, can currently see how much of the country's actual insolvency is sitting one payment away, spread thin across phones, instead of concentrated on a single statement where someone might notice it. The warning signs that used to show up on a credit report now show up nowhere until they show up all at once. In a bank account at 2 in the morning, you didn't avoid the trap your parents warned you about. You just found the version of it that doesn't ask for a signature, doesn't show up on a statement, and doesn't feel like anything until the week it does. The zero balance in your account was never the problem. It's the receipt. If you want the next one of these the moment it's out, how the same phantom account trick already shows up in car subscriptions, in rent, in your paycheck itself. That's what the subscribe button is actually for. And to be clear, none of this is telling you what to do with your own money. It's just what the data shows about where everyone else's is already going.